Okay, good morning, everyone. It's 8:30, so I think we're going to go ahead and get started. Happy to be here in Dayton. We are going to be discussing establishing a client as a real estate professional for purposes of avoiding the passive activity loss limitations. I emphasize avoiding versus evasion. We're allowed to avoid, we're not allowed to evade. So as long as we stick with that, we're typically pretty good. My background as to why I'm up here speaking with you about this topic. Prior to practicing law and being involved in the tax side, I was a FBI agent where I investigated and prosecuted white-collar crime, healthcare, securities fraud, tax evasion, things of that nature. From there, I worked at what used to be Coopers & Lybrand, which is now PricewaterhouseCoopers, and then went on to the dark side of the law firm side. And my practice today consists of representing individuals and closely held businesses in audits, appeals, substantive litigation with the Internal Revenue Service, sophisticated tax collection, since sophisticated meaning something usually more than $50,000, CI work, which is the criminal investigation arm of the Internal Revenue Service, and then advising tax advisors as well as attorneys on discharging taxes in bankruptcy. So I get engaged by a lot of bankruptcy attorneys to be involved in their bankruptcy cases. And then I'm also an adjunct professor at Capital University Graduate Tax Program, where I teach tax planning and controversy courses there as well. How I get involved in this particular topic is typically one of two ways. One is writing an opinion, tax opinion, or at least a memorandum supporting a position on a return for purposes of supporting the tax return preparer, or the audit and appeal work. We've recently litigated one of these cases in the United States Tax Court where we successfully obtained the real estate professional status for one of our clients within the last year, which was an enjoyable case, and I'm going to talk a little bit about that as well. So we're going to go ahead and jump right into it. So, feel free to raise your hand if you have any questions. One of the things I enjoy about talking all the time is I always learn something from someone in the audience and their experience and expertise as well. So if you have any input or thoughts or guidance, please feel free to jump in. So why is this topic important, and why are taxpayers and tax professionals interested? So let's talk about some of the general rules. We're going to be specifically talking about the real estate professional under Section 469, Charlie 7 or C7, and the regulations that follow behind there. So if a taxpayer spends the majority of his time in real property businesses, meets the half personal service test and the 750-hour test, and then also materially participates, they're able to fully deduct their losses. So that's one of the exceptions to the limitations under Section 469. If not, they're limited to the $25,000 deduction that's available under 469 as well. Now, the prior law, prior to 1986, was that a taxpayer could generally deduct losses in full from those activities, but that generated all those tax shelters that were going on. And I had the privilege last week, which was actually pretty cool. I was down in Washington, D.C., and sat in on a discussion with the IRS chief counsel attorney that wrote the original 1986 regulations for Section 469. And then at the same table was the IRS chief counsel attorney that just wrote the 2011 proposed Treasury regulations under Section 469. It just came out in November of 2011. So we're gonna briefly talk about those as well, because if you think about this particular topic is really timely, not only because of the real estate professional discussion that we're going to have, but it comes up in two other instances as well. Most of you, as part of your tax planning that you do, the tax compliance that you do, the word net investment income tax that is now going to be coming up here in 2012, it impacts what a passive activity is, because that applies to passive activities. So we're going to talk about that. It's going to be specifically applicable to this presentation, as well as the new proposed Treasury regulations that came out in defining what a limited partner is. That has been significantly changed under the proposed regulations as well. All right, so a passive activity. A taxpayer generally may deduct the losses from the passive activities against your passive income. This rule prevents the taxpayer from using passive losses to offset income from unrelated non-passive activities. And the disallowed losses are carried forward, or otherwise referred to as suspended losses that are moved forward. Moreover, in many instances, the remaining suspended losses can be taken in full when we dispose of that activity. So if we have a piece of property that we dispose of that has suspended losses, that is one of the exceptions to having to carry those forward to a next year. What we're going to want to focus on and be careful about is when we start talking about the aggregation election, whereby we can aggregate certain real estate together, certain rental activities together, for purposes of satisfying the 750-hour test, for satisfying the personal service test and the material participation test. We have to be careful about that because it has potentially an unintended consequence of, if we want to dispose of a property that has suspended losses, if we aggregated that property together, we may be prevented from doing so under this exception for real estate professional test, similar to the grouping rules and requirements under Section 469 as well. So we're going to talk about that briefly. So what is a passive activity? The term passive activity is defined in a negative. It's any trade or business activity which the taxpayer does not materially participate. To meet we have a number of standards that we're going to go through, but we must, the magic words are, must be regular, continuous, and on a substantial basis under Section 469. All right, rental losses. These are per se passive, so they're generally passive activities and are subject to the passive limitation rules. Now, there are certain instances where those rental activities can be removed from the passive characterization. One is that, first of all, if it's offset against your passive income, we can take the losses in full. The $25,000, special allowance that we mentioned earlier, the qualified disposition that we talked about under 469G, and then the one that we're going to talk about for the next 45 minutes to an hour here, which is the real estate professional test under 469 C7. So again, just to reiterate one more time, the default rules is that rental activities are passive, and then we have certain exceptions if we can qualify as a real estate professional. So let's get into those rules. All right, so we have two tests that we have to meet. One is that it has to be 50% of the personal services performed by the taxpayer during the year or performed in real property, trade, or businesses. And then we have the 750-hour test. The taxpayer performs more than 750 hours of services during the year. Now, yes?
Maybe I'm jumping in front of you, but can you define what they mean by personal services?
I will do that in a couple slides. You're welcome. So these two tests are conjunctive in the sense that we have to meet both of those. And if you read a lot of the cases, the cases kind of mix up these tests, and they don't really break them out, and they also kind of discuss the material participation at the same time as they're talking about each of these. But really, when you get to the end of this presentation, you'll see my just little flow chart at the end. You really have to hit each one of those. So it's a personal service test, 750-hour test, and then the material participation element of that as well. So you have to hit each of those. And then what's also then a little bit confusing when you look at these is that for us to meet the first two, we're looking at the particular taxpayer. So it's that individual taxpayer versus the spouse of that taxpayer. But then when we get into the material participation element, we can combine the time of the two spouses together to satisfy the material participation element of that as well. So we're gonna walk through that. So let's get into defining. All right. So the term real property, trade, or business means any real property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, etc. Again, specifically defined under the Internal Revenue Code. The regulations emphasize that there's considerable flexibility in what constitutes a real property, trade, or business. Most of the ones that I've been involved in are all dealing with rentals. Rental real estate, any real property used by customers or held for use by customers in rental activity. And then personal services, as defined. Any work performed by an individual in connection with a trade or business, excluding any work performed by an individual in the capacity as an investor. So they're wanting to exclude that investor context from this particular rule, which makes sense because that's consistent with the passive activity rules of wanting to avoid that. Yes, ma'am?
And the interpretation, in my opinion, is really vague there, because if you buy, let's just take an average Joe buys a rental property. He is an investor. Now he's doing personal services for that property of which he is an investor.
And you're going to see that as we get through,
Have an agent argue it.
and they should be arguing that point because their Internal Revenue Manual and their training guides tell them to argue that point. When we get into what the specific activities are of what qualify for the 750-hour test, you're going to see that those activities start to kind of come together and be merged. So ultimately, if we're able to establish that they are actively involved, the service, practically speaking, allows a lot of those activities to fall into that so that we can satisfy those rules. And we're going to
Excluding that activity as an investor, how do you rip apart the fact that they are the investor and how they bought the property?
And we're going to talk about that as we go through that. So let's get through some of the examples. All right, so we're going to now look at some of the things that they're going to look at from the Internal Revenue Service's standpoint as to what a personal service is to satisfy the half personal service test. So when we think about this, for example, half personal service means that whatever my personal service is, I have to at least have 50% or more. So if I have a full-time job and I work 2,080 hours, then I have to have 2,081 hours to satisfy the personal service test. And some of the things that the service is going to look at that we don't necessarily look at, well, I don't prepare tax returns, but that you may not necessarily look at, or as an example, what is the occupation that the person listed down on the tax return when they signed the tax return? Some things sometimes come back and bite us, right? And a lot of times you may not have been the one that prepared the return, but you're now trying to assist them after the fact. But those are some of the things we have to look at. What was the occupation for the signature? W-2s, the Internal Revenue Service is going to be looking at W-2s. They're going to focus on who is the real estate professional. Are we talking about, are they married? Is it one spouse? Both? Does that spouse have a full-time job? So the example of the 2,081 hours for personal services that we have to satisfy. This emphasizes the importance of documenting everything, as you'll hear that number of times this morning, of documenting what the personal services were that were performed and how am I documenting my hours if I have to satisfy this particular test. What percentage of each real property business do you own? So we have to have at least a 5% ownership interest to qualify to be involved as a personal service. So if we're able to establish that we have at least 50% or more in the personal service, which I'll get to you one second, which typically we can, especially if it's a non-working spouse that's the one involved in that business. It's more difficult when we have a full-time person that now is suggesting that I also am a real estate professional. In the particular case that we just litigated, the taxpayer, the spouse, was a civil engineer that quit her job to do nothing but real estate, and her husband was a doctor. So in that instance, it was very easy to meet that first element. It was the 750-hour test that we're going to talk about in a moment, that what we ultimately litigated. Yes?
A minute ago, I was trying to understand what the 50% of what means, and you said 2,080 hours, now you're saying 750 hours.
Right, and the reason that is there's two different tests that we have to satisfy, both, again, being conjunctive, meaning we have to satisfy both of them. So we have to, if we performed 100 hours in personal services, at least 50.001% of that has to be in the rental real estate activities. Okay.
Both tests is what you call hours, so to speak.
Correct. Now, if I only performed 100 hours, then I don't meet the next one, the 750 hours, right? So it has to be at least 750 hours in and of itself, just in the rental real estate activities. Right, so that's why it's not. It's a rather difficult test to meet because we only have 24 hours in a day. I don't remember that one case that was litigated a while ago for an attorney where they were able to document that the person was billing 26 hours in a day. I'm not sure how that works out. But as I'm driving back to Columbus today, maybe I can figure that out, right? But it seemed like maybe a little bit of double billing going on there. 26 hours in a day probably didn't work, and it didn't work in that particular case. All right, so then the 750 hours. Time does not count for purposes of the 750-hour test unless the taxpayer materially participates. Again, one spouse alone must meet the 750-hour test. So we're going to get into a number of the cases after we get through the material participation rules of what counts towards the 750 hours. If I own rental real estate, one of the arguments that a revenue agent made to me was that the fact that I was doing landscaping doesn't count towards the 750 hours. And I'm like, well, and you'll see why, because the regulations say that they talk about what an owner would typically do, and an owner typically doesn't do landscaping. And I say, well, then it's a little bit inconsistent with my law firm, because last weekend I was carrying sodas and waters up to my refrigerator, and maybe most owners don't do that, but I did. And why wouldn't that count? So we ultimately prevailed on that argument, but we're going to look at those specific activities. One of the things that comes up a lot is travel time. The Internal Revenue Manual and the training guides for the Internal Revenue Service say that travel time doesn't count. Well, we took issue with that, and that was the issue that we ultimately litigated and prevailed on. And we're going to talk about that in a moment as well. Okay, so the service is going to be looking at, and these are questions that are coming right from the Internal Revenue Manual. How many hours did you spend working on your rentals in the year under exam? The direction from the manual, ask the taxpayer for supporting documentation. So focusing on the appointment books, diaries, calendars, logs. Give a taxpayer log to be completed for each rental. Those words that you use a lot of contemporaneously preparing documents to document the particular activities that we have. When we are looking at just our 162 business expenses, we certainly have to have those documents in place at the same time as well for the real estate professional test. The material participation is on a year-by-year basis, and the service takes the position that rental real estate in and of itself is not a time-intensive process. Again, we dispute that as well, that if that's all you do is own and real estate, that it can be very time intensive. Talk to the person that gets called at 3 o'clock in the morning for owning property down at Ohio State when you have someone that says the plumbing's not working. It takes up a lot of time for owning that property. If non-working spouse claims to be the real estate professional, ask what other commitments he or she may have. Is the spouse a student? Is the spouse providing full-time care to young children? These are some of the things that I'm highlighting for purposes of being proactive. And if we're deciding that we are going to take the real estate professional exception to the passive activity rules, we want to ask these questions up front prior to filing the return to ensure that we have this documentation in place to support our position. And asking these questions ourselves and making sure that we have those explanations before filing the return. All right, and again, we're going to get into some examples of that 750-hour rule in a moment, but let's get through also the material participation test. So we have, again, 50% or more personal services, 750 hours of our time has to be put into the rental real estate activities. So if we think about just someone that owns 20, 25 properties, what is their time involved? They're negotiating the lease agreements. They are collecting the rents. They are doing the landscaping. They are managing the plumbing. They are handling any other issues coming up with the properties. They're involved in the accounting. They're involved in the overall bookkeeping. All of those activities have to be documented and absolutely go towards the 750-hour test that we would want to be documenting. So if we get past those two, then we still must materially participate in those particular activities. And the Treasury regulations highlight what that means. One, the individual participates in the activity for more than 500 hours during the year. The individual's participation in the activity for the taxable year constitutes substantially all of the participation. The individual participates in the activity for more than 100 hours during the taxable year, and such individual's participation in the activity is not less than participation in the activity for any other individual. Once we get past the personal service test and the 750-hour test, in most instances, the material participation is easier to satisfy. Most of the litigation, when dealing with a real estate professional, is whether or not they satisfy the 750-hour test or the personal service test. You can see why the personal service test would be difficult to meet if you're an employee or a full-time employee because of the amount of hours that are only available to us in a day. And then when we look at the 750 hours, again, focusing here on the material participation elements, many of them don't even require 750 hours. The activity is a significant participation activity, which is defined under another code section, and the total hours have to exceed 500 hours. The individual materially participated in the activity for any 5 taxable years within the last 10 taxable years. And then 2 more, I just want to get out. The activity is a personal service activity, and you participate in 3 preceding taxable years, and the last one's a facts and circumstance test, that if you don't satisfy 1 through 6, that you could potentially argue that you still materially participated in some way. I'm not sure if anybody's had number 7. I've never had that particular case. I would think that it's a pretty hard argument to make if you don't satisfy 1 through 6 to fall under the catch-all facts and circumstances test. Usually, when we are looking at this, number 1, if we are involved in and satisfied the 750-hour test already, the number 1 here is probably one of the more easiest ones to satisfy. The individual participates in the activity for more than 500 hours during the year. And again, remember, once we get past the first 2, this also includes our spouse's time for the material participation element. Okay, get back in. All right, so some of the questions that we're going to get from the Internal Revenue Service when it comes to material participation. Again, these are questions that I've accumulated from actual audits that were asked during the audit process. Who monitors the rentals? Who collects the rent? Who does the repairs? Many investors in real estate have management companies that handle the everyday operation of the rental properties. Those individuals are not the type that the service is looking for that satisfy the real estate professional test, right? We're looking at that person that was actively involved in the actual operation of those rentals. So when they ask the questions of who monitors the rentals, who collects the rents, who does the repairs, they're looking to see if there's anybody else that's involved in that process. And to the extent there are, they want to know how much and whether we participated more than them. These type of questions, though, ultimately help us when it comes to pre-audit planning in making sure that we're documenting that we are the real estate professional, because here's what we are doing. We are monitoring the rentals. We are collecting the rents. We are advertising. We are doing the actual repairs ourselves. Many of you out there, as well as our clients out there, are very hands-on and get involved in a lot of things. I'm not that person. I wouldn't be able to fix the toilet when there's difficulties. I just had a plumber come out recently and charged me $150 to change out the thingamajigger in the toilet inside that all required. He was literally there for like 5 minutes. And I didn't like writing that check, but unfortunately I had to write it. Do you have a real estate agent or manager or employee responsible for any of the rentals? Ask for each rental property. So they're going to be identifying each of the properties. They're going to check the Schedule E properties for large commissions or management fees. Again, they're looking for ways to eliminate the possibility of you materially participating or having 750 hours or more. They're looking at who else is involved in the business. Check for large labor expenses, possibly hired a contractor. If there is paid management, it's a strong indicator the taxpayer did not materially participate. Again, these are coming right out of the Internal Revenue Manual, questions that they're going to be asking as part of that audit process. So is anyone else besides you involved? Does a relative or friend manage the property for you? So we had one where we were looking at potentially trying to qualify, but it ultimately was determined that they engaged one of their tenants to handle the management of the property for them. And they did that in each one of their properties. So when it came to looking at the material participation, when I was asked to write that opinion, I ultimately told them I couldn't write that opinion to satisfy this because we didn't believe that they materially participated because of their involvement in the tenants that they had, and they were doing a little bit of a quid pro quo of rent for management fees. So although it didn't show up as a management fee on the tax return, which arguably I guess it should have still, right? When we have that quid pro quo, we should still be showing both sides of that. It was not showing up, but they didn't also materially participate because there was others involved. Does a tenant receive free reduced rent for managing the rentals or for caring for the properties? All right, so they're looking at those facts and circumstances to determine whether you did actually materially participate. Now, one of the problems with the material participation is that we have to materially participate in each and every property. So what has happened in the past is that in many instances, when we list all of those properties down, and the service comes in and audits us and then is looking at, okay, did we meet the personal service test? Yes, we met that. We met that because 50% or more. The 750-hour test was met. We had more than 750 hours. But then when they looked at the material participation test, they said, okay, well, you have to materially participate on each and every rental property. So if we look at one of those elements, the 1 through 7 that we just mentioned, I have to have 500 or more hours, or in one of them was 100 or more hours on that particular rental property. So if I have 30 rental properties, those hours add up pretty quickly, right? And likely I'm not going to materially participate in each and every one of those properties. So they have this aggregation election that allows us to aggregate our properties so that we only have to meet that material participation requirement as it relates to that group of properties in the aggregate. The problem we've had over the years is that this was an election that was required to be made on the originally filed return. And if one of two things happened, either the tax return preparer wasn't aware of this election or the election was not made appropriately, then we could not go back and amend the return to make the election, even when we're amending that return within the statute of limitations for doing so. And that then, of course, became problematic. So we then started coming up with creative arguments. Those arguments would be, well, if you looked at the tax return, we effectively made that election because the preparation of the tax return is consistent with the fact that we made that election. And that although that we didn't file the proper form, check the proper box, we still made that election. Well, those cases came down against us the majority of that time. The courts were very clear that this was something that had to be done on the original return and had to be done correctly with the proper election. So the law expressly allows a taxpayer to elect to treat the interest in real estate as one activity. To make the valid election, regs require it to be filed on the original return. Now, they have changed that for us, and this was very recent. This is similar to many of you that have dealt with the late filed S election for one of our businesses, where they failed to file the S election by March 15th of the year, for which we are trying to be treated as an S corporation, and we have various relief provisions that are allowed for us there. Well, we now have a revenue procedure that came out in the middle of 2011, which was RevProc 2011-34, that allows us to go back under certain facts and circumstances to elect the aggregation for purpose of the real estate professional test. This is here to give us that relief that was not there before, meaning if we didn't do it on the original return before, we were out of luck and we didn't qualify, and those losses are going to be carried forward because they were going to be suspended. Yes?
This aggregation election, you have to do it on the first property that you ever buy, or what does that mean, the original return?
The original return would be the first year that you intend to aggregate the properties together. So it would be if I'm doing it for this year, if we treat them differently for the years before, then it wouldn't have applied for those particular properties. So if I collected, 2 properties in 2002, 5 more in 2005, and now in 2012 I have 20 total, and I decided today to aggregate, it would be on the filing of my 2012 tax return that I would aggregate those. The concern that you have is rolling back that aggregation election. There has to be, and I don't have the wording off the top of my head, but there has to be some material change to your circumstance to allow you to revoke that aggregation election. But the revenue procedure, just want to lay out the elements quickly for you. Again, it's 2011-34. If we don't satisfy this revenue procedure, you then have to do what you're more familiar with likely for S corporations is then request a private letter ruling request for purposes of aggregating. So the service does have the authority to do so, but then you have to go through that PLR process, which many of my clients that is in some form of controversy is not going to do. They're not going to pay us to do that. Now, I guess if the dollars are significant enough, maybe they would. The requirements for this revenue procedure is that the taxpayer failed to make the election solely because the taxpayer failed to timely meet the requirements, meaning that they didn't do it on the original return. The taxpayer filed consistently with the fact that they did intend to aggregate. The taxpayer timely filed each return that would have been affected. They have to make the election within 6 months, and the taxpayer has reasonable cause for failure to meet the requirements. So that reasonable cause, if you're familiar with that standard, usually comes up in terms of dealing with penalties, right? The failure to file, failure to pay penalties, failure to deposit penalties, accuracy-related penalties. What does reasonable cause mean in this particular circumstance? And I think it's clear that reasonable cause can be that I relied on my tax return professional to notify me that this election was available. So if they didn't notify me that the election was available, then I think that I probably have reasonable cause and would want to get an affidavit of a tax return preparer to support that. The error in electing incorrectly on the return, meaning I intended to elect, but we didn't file the election, but I was not aware of that, again, as the taxpayer. As you all know, the taxpayers, the first thing that they do is throw us under the bus when something doesn't go right, right? So a lot of times we're willing to be thrown under the bus if it's the right circumstance, but not all the time. So we have to meet these 4 requirements. Again, if we don't meet these 4 requirements, we still have the ability to aggregate, but we then have to go through the private letter ruling request process, which typically is not as easy and certainly much more time-intensive part of the process. Emphasize again that the unintended consequence of the aggregation election is that if we have a property that has been aggregated that did have suspended losses in a prior year, I've not had this particular circumstance, maybe one of you out here have. When you now want to then sell that property and those suspended losses are there, it's not like we can just all of a sudden say, okay, this year we're not going to aggregate. And therefore you have to be careful about that in planning, because there has to be some significant change in circumstances before you can then revoke that aggregation election. What I didn't do, and I forgot to do before this morning, was to look back and check whether we had to get actual approval from the service to do that, like an accounting method change. I don't recall that, so I'm not sure if anybody's dealt with that here before, where you've revoked that aggregation election, of whether or not that has to be approved versus just going ahead and doing it on your return and hoping it doesn't get identified. Yes?
Well, how does it work when you sell a property?
Well, in general, if I'm just selling one piece of property and I'm not aggregated, then those suspended losses become losses that I can now offset against my other income immediately in that year. So I've had one actually here in Dayton, where it was a super fun property, for lack of a better, I know that that's not the complete proper term, but it was an environmentally hazardous property that we effectively, through following the Treasury regulations, abandoned the property back to the city of Dayton. And in that circumstance, an abandonment also is considered a sale and allowed us to take advantage of very significant suspended losses in that particular instance.
If it's aggregated, then.
If it's aggregated, then I'm going to be stuck with those losses until we're able to identify enough income in the future to offset those losses. But the problem is getting that property out. So I've not had that circumstance where I've had to, as I mentioned a few minutes ago, where I've had to revoke that election. And so I don't know the answer to that off the top of my head on the best way to do that. But there has to be a change in circumstance. Well, one second, maybe she has the answer. Go ahead.
Well, I don't think I have the answer.
Okay, fair enough.
But I have a thought that, and I've never had this situation either, but if you're there could be a circumstance, I'm just gonna throw this out, that, as I understand it, that if you treat the real estate management as a business, and therefore you're reporting on Schedule C, the homes become inventory, and therefore you can, even though under this, it wouldn't be an aggregate per se, it would be inventory. And then you just sell one and, essentially never inventory.
Yeah, I'm not sure about that. Certainly outside the scope here this morning, but it's an interesting thought. I just don't know the answer to that.
I just thought of it.
Yeah.
I just thought of it.
But the standard, again, that we have to meet is there has to be a material change in circumstance to allow us to revoke that aggregation. And we have to identify what that is. And you know, it may be that we've had one of our properties burned down, that we're arguing that we should be able to revoke that aggregation. But there's no specific guidance on that particular issue. So if we're wanting to sell a property, we have to be planning ahead on trying to identify case law that's out there that already gives examples of what that material change in circumstances was that allowed that particular taxpayer to do that. Or what I typically would do is call the IRS Chief Counsel's office up and ask for the person that specializes in handling Section 469 of the Internal Revenue Code, which is absolutely what we can do because they are assigned by Revenue Code, and talk through the circumstance with them and going through that planning process. Yes, ma'am.
I don't know if I'm missing something. Normally, would the purpose of doing the aggregation election be to prove material participation amongst all those properties, and the main purpose would be, as current being the real estate professional, so you wouldn't have to worry about those passive losses. So why would it be a problem if you sold one of those properties? And did you say you would have to wait until you have passive income to offset it? But you do the real estate profession, if that was the purpose of doing this.
It's my understanding that those passive activity suspended losses that occurred prior to the year of aggregation are the issue that we have. So it's kind of similar to when if I'm a C corporation and I elect S corp status and I have built-in gains, that's what we're dealing with. Okay, no problem. All right, I'm going to try to get through some of these miscellaneous issues. One spouse alone must meet both tests. We talked about that for both the personal service test and the 750-hour test, that we have to have at least a 5% ownership interest. All right, so substantiating the documentation, the method of proof. I want to emphasize this for a moment because it's a little bit misleading. So the Treasury regulations go into this. The extent of an individual's participation in activity may be established by any reasonable means. Contemporaneous daily times, it goes on to say, aren't necessarily necessary. But if you read all the cases and you talk to any revenue agent, they don't look at their own Treasury regulation, because a lot of times when we try to use reasonable means to document something, they always come back to, I need contemporaneous records. Where's your log? So we have to have those logs, because from a practical perspective, they don't follow their own Treasury regulation when it comes to this, and neither do the cases law that is out there. We absolutely need those contemporaneous daily time reports logs, or similar documents to support our position. Now, I'm not saying that we can't, as tax professionals, come up with those creative arguments of how else we're doing that, but certainly logs that are created after the fact are not seen as credible evidence to a tax court. Now, we can argue that those logs were created based upon other documents that we have, such as our calendars. We know that we went from this point to this point, that maybe we can ultimately get there. But if we're absolutely going to be documenting this, we want to have those contemporaneous records prepared. And as we know, most real estate professionals, they have difficulty with that. You as CPAs, or some attorneys that may be in here that are also CPAs, us type A people, we document everything, right? So it's a lot easier for us to be thinking that way because we're doing that. But those creative minds, entrepreneurs, don't think the same way. Now, they certainly have a lot of technology that's available today that makes it a lot easier, certainly when it comes to things like logs and applications that are out there that are available to us. So that certainly makes it a little bit easier, but we absolutely have to have those records. Okay, so non-qualifying time, we brought up before. Certain hours that do not count for the material participation. Investor-type activities do not count unless the taxpayer is directly involved in day-to-day management. So again, that goes to that exception that says, yes, investor activities in and of itself does not count. But if I'm the one that's doing the landscaping, and I'm the one that's handling signing off on the lease, I'm the one that's collecting on the lease payments, the fact that I'm also looking at how's this property doing, and is it something that I want to continue to maintain because the appreciation and value continues to go up, those type of activities, in my opinion, will qualify. The Treasury regulation provides that the following types of activities do not count unless, again, that they're directly involved. Studying and reviewing financial statements. So these are the investor activities. Preparing and compiling summaries or analysis. Monitoring finances or operation in a non-managerial capacity. Work not ordinarily done by an owner is not counted. This is work that would normally be assigned to an employee. So again, this goes back to my landscaping example. I've had this brought up to me with a revenue agent saying that, well, the fact that you're doing landscaping, that doesn't go towards the 750-hour test. And I said, well, I'm not sure who else is going to do it. We don't have the employees to be able to afford to go out there and do that. So I think that practically speaking, although the Internal Revenue Manual and their guidelines say that this type of work doesn't qualify, that under the right facts and circumstances, that it absolutely will. Travel time generally should not be considered in computing the hourly test. This is the services, I'm copying and pasting this directly from their training guide, not something that I created on my PowerPoint. So this language that travel time generally should not be considered in computing the hourly test for material participation, particularly if other factors indicate the taxpayer is not participating, should not count. Again, this is directly from the service. Legislative history provides that the services must be integral to the operations, and they don't believe travel time is integral to the operations of a rental activity. And we had this, as I mentioned, argument come up, and where we had a taxpayer that was traveling from this area to Columbus, where all of the rental properties were located. And our argument was that every time that she traveled to Columbus and back, and certainly all the in-between rental properties, and she was very meticulous in documenting her travel log and the amount of time that it took, that all of that qualified to get us to the 750 hours. If that didn't qualify, then we weren't a real estate professional, and then we had some difficulty. So we weren't involved in the audit. We got involved in the appeal. The revenue agent didn't agree with the tax return preparer. The appeals officer didn't agree with us. And ultimately, then we had to file a petition in tax court. And the day before the trial, the service conceded the case in full. Unfortunately, we then sued the service to collect our attorney fees, which were pretty significant because we had done everything, including prepare for trial right before them conceding. But the tax court, in its wisdom, disagreed with us recently in a 49-page opinion that went against us. So we didn't get our attorney fees, but they did concede the case, and they conceded the case because we were able to establish that in this particular instance, the real estate investor, the real estate professional, excuse me, her home office was her, she had a home office. And therefore, they were arguing that that travel time is no different than commuting expenses under Section 162, and therefore, you can't take commuting into consideration, and therefore, in this case, you don't count travel time. And I couldn't get the appeals officer past that. It kind of blew my mind a little bit. And ultimately, and you call the IRS chief counsel's office who gets assigned to the case, and they're like, well, when is that case set for trial? X date. Well, call me a month beforehand, not 9 months ahead, not 9 months beforehand. I've not looked at that case or even had time to look at that case. So what did I have to do between that 1 month, which was prepare for that case, right? There's a lot to do in that particular instance. Ultimately, when they looked at this, and we're going to go through some of the cases, we were able to persuade them, and they conceded the case in full. So travel time, when we have a home office, absolutely qualifies, and there are some cases that I will get to that also support that. Okay, so this James F. Moss case, the tax court counted 137.75 hours of the taxpayer's travel going to and from his rental properties and 500 hours of taxpayer's work on his rental properties towards the 750-hour test. Unfortunately, he was still under 750, but this case supported our position that, hey, wait a second, we do count travel time. Shaw case is another one. It's also cited by the Internal Revenue Service that the taxpayer was able to establish through flight logs that going back and forth, I think that I'm not sure I have it in there, but I think it was Hawaii where the rental properties were located, that should count towards the 750 hours. And the tax court agreed that those hours did count. Unfortunately, they didn't have sufficient hours in this particular case either to get us to the 750 hours. Then there's a field service advice that advised that the taxpayer's primary purpose for visiting Ocean City rental properties, dealing with those properties, whether it was personal time or not. But again, this is another persuasive authority that we would use to cite for the position that travel time does qualify. So the Moss case, the Shaw case, and then this field service advice, in my opinion, kind of clarifies the issue for us that travel time will qualify under the right circumstances. So as part of the audit, the service will likely assert that the travel between the taxpayer's residence and properties do not count. We have to, maybe the word educate is not the right term because they may be posturing and taking that position intentionally, knowing that this other law is out there, recognizing that some individuals may not be aware of that other law and therefore making it an easier case for them. But to the extent that we are aware of it, we want to distinguish between, Section 162 and the other relevant code sections dealing with a real estate professional test to establish that commuting is different than travel time in this particular context. The one other case, and I'm not going to go through it because we're not going to have time because I want to get to a few other things, is this Truskowski v. Commissioner case that the tax court ruled against the taxpayer. But again, I think as any creative person, tax professional, that this case also can be used and distinguished and held in our favor for purposes of the travel. That is in the PowerPoint that goes through the facts and circumstances of that particular case. Let me just get through that. Okay, so issue identification as part of the audit. So if we're involved in preparing a tax return where we are taking the position that we are going to be a real estate professional, mainly being involved in the audits and the appeals, when I am asked to give advice on a tax planning, I always try to look at it from the perspective of the Internal Revenue Service and how they're going to attack our position, right? Because it seems like if we focus on how the service is going to attack it, and let's say we're going to be audited, so we're going to talk about in the next session dealing with audit and appeals with the service about what the percentage of being audited is. But if we just assume that we're going to be audited, how is the Internal Revenue Service going to attack our position? And then if we address those attacks up front, then we're in a much better position when it comes to being audited. So the first, again, the revenue agent's going to check to see if all of our Schedule E rental real estate losses have been deducted as non-passive, possibly not considering the fact that the taxpayer must materially participate in each rental activity. They're going to examine the taxpayer's occupation, identified on the signature block and on Schedule E of the line 43. Again, the taxpayer must spend the majority of their time in real estate professional businesses. So if they are a doctor, and we all have a dentist out there, right? Dentists work 25 hours, maybe 32 at the most. They all have fairly nice nest egg or other money that they want to then invest in. And typically we see a lot of dentists that they're entrepreneurial. They're a little bit more than maybe a medical doctor. And they have some cash, and so what do? They invest in real estate all the time. They not only own their property for their own dental practice, but they have other real estate here and there. And so if they're working 28 hours a week, certainly I think that's one case that we can absolutely argue that they're a real estate professional, and we have some of those because there's a lot more hours in a week than 28 hours out there, so we can absolutely establish that. We'll review the Schedule E activities, the Schedule K1s, Form 1065, 1120Ss, W-2s, basically any information return that is out there that's available to the Internal Revenue Service. And one way that we can make sure that we have those as well is we can order from the Internal Revenue Service the wage and income transcripts, right? The wage and income transcripts come out in June of every year for the prior year. So we are in May, so the wage and income transcripts for 2011 will be out, if not already now. It's usually not until June, but maybe sometimes May. We can order those for a particular taxpayer that would have all the W-2s, 1099s, 1098s, K-1s, all of those information returns. A lot of times if we have extended the due date for filing an individual's return, that's one good due diligence option for us from preparing a return, is to get those wage and income transcripts to make sure that we match up what was given to us by the taxpayer to make sure that we don't end up having a correspondence audit for purposes of making sure all of our information returns matched up. So another way to use this, again, it's a tool available to us, is that we want to see what those information returns are that are out there, and then maybe actually get the document to see what professions that are potentially out there that the service may be looking at. Just quickly through a few more of these, the revenue agent want to determine whether the taxpayer materially participated in one or more specific activities, who's the real estate professional, husband or wife, request closely examine the taxpayer's documentation for each of those, scrutinize other activities that the taxpayer is engaged in. And I got 6 minutes, so I want to get through a few more things here. During the initial interview, the revenue agent will question the taxpayer regarding time spent on all these activities. So it's very important that we are preparing our taxpayer to the extent we weren't able to avoid having our taxpayer interviewed. So I usually try to avoid that, first of all. But if we're not able to avoid that because we either got a summons or we have a very aggressive revenue agent, then we're going to have to prepare them for that. The revenue agent will look for time spent by others in the activity. They're going to question the taxpayer about the election and the aggregation. So if we've not addressed that up front, we're going to want to do that. They're going to request copies of the return with the election. They're going to review prior and subsequent years' returns. Remember, this is a year-by-year analysis. We can materially participate in one year and not materially participate in the next year, just depending on those facts and circumstances. So the service is going to look at that as well. They're going to scrutinize any passive income on the Form 8582. All right, and then, am I a real estate professional? So I am we're giving a presentation to a bunch of real estate professionals, or agents / brokers / next month, and of all of these slides, I think this is the only one I'm going to give them, right? I don't think they're going to like any of the other ones, so they won't get through it, at least. So this is just a real quick flow chart that went to the one person's question about hey, this 750-hour test, this personal service test, it's confusing. This makes it real easy. Test 1 and test 2. We first have to be personal service. We then have to have the 750 hours, and then if we meet both of those, we then have to materially participate. For purposes of material participation, it's activity by activity. If we don't aggregate, if we aggregate, then it's all of them together. We're typically wanting to aggregate those unless we're thinking through those unintended consequences. If we think we're going to be selling a property that has suspended losses, we're going to be careful about that. Maybe we want to hold off and aggregate next year, depending upon those circumstances. The one thing I wanted to mention also is if you think about, so that's on real estate professional, but again, I just want to hit the other two relevant areas where this concept of passive activity is going to be very significant for us in 2012. So again, if we think about what the Congress called the unearned income Medicare contribution tax, but if you think about that, it's not really a Medicare tax because it's going, the money that's coming in from that tax is actually going to the general fund of our government. So it's really an income tax. And so that's why that's why the service called it the net investment income tax. But if you look at the definition of that, net investment income means the following types of gross income or net income less deductions properly allocable to the same gross income derived from a trade or business that is either a passive activity or income from a financial instrument. So again, our passive activities where we are going to be subject to this additional 3.8% tax if we are over the threshold amount potentially could be significant for some of our clients. So in addition to looking at just, are we a real estate professional, we're also looking at, well, is there a way to avoid this 3.8% tax? And that also is, the sweet spot that we're looking at, or looking for, I think, is we want to avoid having that income subject to self-employment under, right? And then we also want to avoid having it treated as passive. So that's kind of the planning that is out there, I think, for all of you in 2012 when it comes to passive activities. Then we look at the proposed Treasury regulations under 469 that just came out in November of 2011 that really changes the landscape of dealing with the limited partners based upon a number of cases, actually 5 of them, where the Internal Revenue Service lost all 5 cases dealing with whether or not a particular person was a limited partner or not. And in that, they changed the definition of a limited partner. Now these are, again, proposed Treasury regulations. They're not final, they're not temporary, and therefore they're just out there for persuasive authority. But it's likely that after they get additional comments, that ultimately these are going to be the rules that we're going to be dealing with. And I'm just going to read one particular section that's probably very important to all of you here, which is that the regulations provide that an interest in an entity should be treated as an interest in a limited partnership under 469 if the following 2 requirements are met. The entity in which the interest is held is classified as a partnership for federal income tax purposes. So we have, what we're dealing with now, right? LLCs, taxed as partnerships. And the interest holder does not have rights to manage the entity at all times during the entity's tax year under the law of the jurisdiction in which the entity was organized. That is a huge difference, a big change in the current Treasury regulations. So now we're focusing on the management activities. So if we think about LLCs, we have member-managed LLCs and we have manager-managed LLCs. So depending on not whether we're wanting to be a limited partner or not, it's going to be really your job to educate the business attorneys out there that are clueless when it comes to taxes about their form operating agreement that they give to a client, and the client didn't want to pay for an operating agreement, so they just grabbed one of their forms, and it was a member-managed operating agreement when they were supposed to be a manager-managed operating agreement, and we have those circumstances every day, right? So it's looking at those actual provisions within the operating agreement to see if we're going to meet these new Treasury regulations that are out there. Again, depending upon what side of the tracks we want to be on, of whether or not we're a limited partner or not. Now they go into a number of other things as well, and the only thing and we of course don't have time to talk about all of those, but the only thing I wanted to mention is in those proposed Treasury regulations, they make it very clear that the definitions in dealing with what a limited partner is and who a limited partner is only applies to Section 469. It cannot be used for other purposes like planning of whether or not I'm subject to self-employment tax under other code sections. So the Treasury regulations make it clear that that argument, that citation of that Treasury reg cannot be used for that purpose. Seems to me a little bit difficult for the service to take that position if there's no other law out there that tells us how to do that, and that ultimately the courts are going to ultimately adopt that concept. But right now the Treasury regulations make it very clear that it's solely for purposes of Section 469.